Welcome to the video lecture on Financial Instruments and Markets. In this chapter, we are going to learn about hedge funds in global market. The topics covered in this chapter are hedge funds and hedge ratio, leverage, private equity investments and its categories, foreign institutional. Hedge means making an investment to reduce the risk of adverse price movements in an asset. An example of a hedge would be if one owned a stock, then sold a future contracts stating that the person would sell the stock at a set price, therefore avoiding market fluctuations. Hedge aggressively managed portfolio of investments that uses advanced investment strategies such as leverage, long, short and derivative positions in both domestic and international markets with the goal of generating high returns either in an absolute sense or over a specified market benchmark. It is important to note that hedging is actually the practice of attempting to reduce risk, but the goal of most hedge funds is to maximize return on investment. The name is mostly historical, as the first hedge funds tried to hedge against the downside risk of a bear market by shorting the market. Mutual funds generally can't enter into short positions as one of their primary goals. Hedge by fixed income arbitrage. Fixed income arbitrage is primarily used by funds and leading investment banks. The most common fixed income arbitrage strategy is swap spread arbitrage. This consists of taking opposing long and short positions in a swap and a treasury bond. Such strategies provide relatively small returns and in some cases huge losses. Hedge ratio. A ratio comparing the value of a position protected via a hedge with the size of the entire position itself. A ratio comparing the value of purchased or sold to the value of the cash commodity being hedged. The hedge ratio is important for investors in future contracts as it will help to identify and minimize basis risk. Leverage. Leveraging means the use of various financial instruments or borrowed capital such as margin to increase the potential return of an investment. It refers to the amount of debt used to finance a firm's assets. A firm with significantly more debt than equity is considered to be highly leveraged. Most companies use debt to finance operations. By doing so, a company increases its leverage because it can invest in business operations without increasing its equity. Leverage helps both the investor and the firm to invest or operate. However, it comes with great. Private equity. In finance, private equity is an asset class consisting of equity securities in operating companies that are not publicly traded on a stock exchange. There are a wide array of types of equity, and the term private equity has different connotations in different countries. Private equity investments can be divided into the following categories. Leveraged buyout, LBO or buyout. LBO refers to a strategy of making equity investments as a part of a transaction in which a company, business unit or business assets is acquired from the current shareholders, typically with the use of financial leverage. The companies involved in these transactions are typically more mature and generate operating cash flows. Venture capital financing. It is a financial service coming under the broad subcategory of private equity that refers to equity investments made typically in less mature companies for the launch, early development or expansion of a business. Venture capital is often subdivided by the stage of development of the company ranging from early stage capital used for the launch of startup companies to late stage and growth capital that is often used to fund expansion of existing business that are generating revenue but many not profitable or generating cash flow to fund future growth. Growth capital funds. GCF refers to equity investments, most often minority investments in more mature companies that are looking for capital to expand or restructure operations, enter new markets, or finance a major acquisition without a change of control of the business. Distressed or special situations. These can refer to investments in equity or debt securities of a distressed company where value can be unlocked as a result of a one-time opportunity. Example, a change in government regulations or market dislocation. Mezzanine capital funds. MCF refers to subordinated debt or preferred equity securities that often represents the most junior portion of a company's capital structure that is senior to the company's common equity. Real estate funds. Real estate funds in the context of private equity will typically refer to the riskier end of the investment spectrum, value added and opportunity funds where the investments often more closely resemble leveraged buyouts than traditional real estate investments. Certain investors in private equity consider real estate to be a separate asset class. Infrastructure funds. Infrastructure investments in various public works, example, bridges, tunnels, toll roads, airports, public transportation and other public works that are made typically as part of a privatization initiative on the part of a government entity. Energy and power funds. These investments are made in a wide variety of companies rather than assets engaged in the production and sale of energy, including fuel extraction, manufacturing, refining and distribution, or companies engaged in the production or transmission of electrical power. Private equity investments. Institutional investors provide private equity capital in the hopes of achieving risk-adjusted returns that exceed those possible in the public equity markets and will typically include private equity as a broad asset allocation that includes traditional assets, example, public equity and bonds. Private equity firms generally receive a return on their investments through one of the following avenues. Initial public offering, IPO, a merger or acquisition in which the company is sold for either cash or shares in company. A recapitalization, funds or cash is distributed to the shareholders, in this case the financial sponsor, and its private equity funds either from cash flows generated by the company or through raising debt or other securities to fund the distribution. The various considerations for investing in private equity funds related to other forms of investment include to fulfill substantial entry requirements, limited liquidity, to gain investment control, to fulfill unfunded commitments, to mitigate investment risk, and to get high returns. Foreign institutional investors. FIIs invest in money markets and capital markets on day-to-day basis, and they are traders and short-term investors and are not capital fund providers and are not project investors. An investor or investment fund that is from or registered in a country outside of the one in which it is currently investing. Institutional investors include insurance companies, pension funds, and mutual funds. Monitoring foreign investments. The Reserve Bank of India monitors the ceilings on FII or NRI or PIO investments in Indian companies on a daily basis. For effective monitoring of foreign investment, ceiling limits, the Reserve Bank has fixed cutoff points that are 2 percentage points lower than the actual ceilings. Some examples of the institutional investors are pension funds and life insurance companies. That's all for this chapter. Thank you.